Whenever we have a transaction involving property, such as a sale, exchange, or involuntary conversion of property, there are three steps to consider in this order. Step 1, calculate the realized gain or loss. Step 2, determine the recognized gain or loss. And Step 3, determine the character. For Step 1, Code Section 1001 requires us to calculate the realized gain or loss on the transaction. This is the amount realized minus the adjusted basis. This formula is arguably the most important formula in the entire tax law. Also, it is heavily tested on the EA exam along with many other property transaction rules. For Step 2, in general, realized gain or loss is recognized and reported on the tax return. There are exceptions if there are non-recognition, exclusion, or disallowance rules that apply. For this video topic, let's assume we have a realized and recognized gain or loss from Step 1 and 2, which means it would be reported. We now move to Step 3, determining the characterization of the gain or loss. On a tax return, there are ultimately, at the end of the day, three categories of character. They are as follows: ordinary, long-term capital gain or loss, and short-term capital gain or loss. Character makes a big difference for taxpayers as different tax rates and limitations might apply. Generally, if a taxpayer other than a corporation has a gain, they prefer the gain to be long-term capital gain because it provides a lower tax rate than ordinary gain. With property transactions, the general idea is that if something is not a capital gain or loss, it's considered ordinary. There's a general rule that determines if a gain or loss is capital gain or loss. If the asset is a capital asset and there's a sale or exchange, the gain or loss will be considered capital. Next, it's considered long-term if it's held more than 1 year and short-term if 1 year or less. Debt and equity securities held by investors are capital assets. Accordingly, gains and losses from the disposition of securities are generally determined and taxed like gains and losses from the disposition of other property. A return of capital distribution reduces basis and becomes a capital gain when the shareholder's basis in the stock reaches zero.